Blaster, where we blow apart the stock market and put it back together so that it makes sense for you. I'm Forbes Markets Editor John Dobis. I'm joined today by Matt Freund. Matt is Senior Vice President at USAA Investments. You oversee something like 46 mutual funds?
Correct.
Number of chromosomes in the human body too, right?
There you go.
Some kind of connection right there. In any case, you're trying to unravel the DNA of investments over there. Doing a decent job at USAA. What does USAA stand for?
United Services Automobile Association.
And you don't need to be in the Army to own these funds, right?
Correct.
That's good.
That's our lineage, but we are open to all.
You're a diverse financial services company. How is the bull? The bull market kind of began, you might think, like October 3rd of last year. Things have really come off the bottom.
Really started getting rolling right around Christmas time.
The LTRO in Europe helped out.
Absolutely.
Things have gone to the races. Risk has been back on, in other words.
It has. Yesterday it came off a little bit, but no, we've been very, very pleased. It's interesting. What really did well for all of last year didn't do so well since the end of December, so we've seen a little bit of reversal with quality and the rest, but no, the technicals are great.
So you got equities and fixed income and all that reporting into you.
Absolutely, yeah.
You know, is there anything looking more attractive than the other? Obviously, with the risk-on trade being there, high-yield debt and equities would seemingly be the asset classes of choice.
Yeah, no, exactly. So we like quality stocks and low-quality bonds.
Okay.
And so we're kind of bookmarked on either
That's
side.
in the high-yield opportunities fund here?
The high-income fund.
High-income fund. They still call it the high-yield opportunities. High-income, because you do buy investment-grade stuff.
No, we'll buy, it's really wide open. We can buy stocks, we can buy below investment grade bonds, junk bonds, or go investment grade if that's where the best
Because this sucker has
opportunity
outperformed the JNK and the HYG, the
Yes, it
ETFs
has.
that track the junk bond index.
Absolutely.
What kind of paper do you put in there? What kind of things do you own, like Microsoft in there right now?
So, you know, it's interesting. We do. We have primarily high yield bonds. So, you know, it is a below investment grade fund. But one of the things that we found attractive is to put in high quality stocks when we can buy them for the right price.
You look back here, Microsoft, your quality came alive in 2012 from $26 up to $32. Microsoft.
That's right, and that's been one that we've held for quite a while in that fund. The great thing about a company like Microsoft or the other high qualities are very high quality cash flows, relatively low debt, decent dividend yield while you wait, and good growth prospects. You put that all together, you know, it can be attractive relative to other high yielding
the Band-Aid company, Johnson & Johnson.
Johnson & Johnson, another great example. So Johnson & Johnson has a yield north of 3%, selling for under 13 times earnings, getting through some of their problems in terms of manufacturing and quality control, and again, just a great global platform.
One thing you look at is the earnings yield. Earnings yield is what, the PE ratio turned upside down?
That's right. It's the inverse of the PE ratio.
So Microsoft's got about an 11 PE, 11.5 PE, so about an 8 or so?
Yeah, a little bit more than 8.
So you want it to be higher than what? You want it to be higher than the 10-year yield or the?
No, actually, we're going to compare that to what we can do with other high-yielding companies. So, in the high-income fund, we're not just comparing it to treasuries. We're comparing it to what we can buy and the risks we're taking.
Or back of the envelope would be like maybe a junk bond yield?
Yes, exactly.
Okay.
That's exactly right.
So look for the JNK, right? Or something like that. Some junk bond index.
JNK or HYG.
Take a stock you're thinking about, do the inverse of the PE. If it's higher than the yield in the junk bond, chances are you've got yourself a decent value.
A decent value there.
In the energy sector, Chevron, kind of like Exxon, kind of like Conoco, but hitting new highs here near 110 bucks.
It is, but on an earnings basis, it's actually you know, very attractively valued. And some all of the stocks we've mentioned are actually cheaper or more attractively valued than they were before the crisis started. So it's not just the price; it's how much you're paying for the earnings.
Got the map right behind us here showing Europe. A lot of things going on. The LTRO.
No, it's all solved.
It's all solved, sure. No,
yeah,
he's joking.
I was joking on that. No, so Europe is harder. People are making it harder than it has to be. Really, when we look at Europe, we're looking for 3 things to happen to see if we can put these problems behind us. The first one is we think that European institutions need more capital. So it's not liquidity, it's solvency. They need capital.
That's bad, right? I mean, that's like, oh, it's not just like, I just don't have it on me, but I've got it at home. You're saying they've got it on them, but they don't have anything at home.
Right. So the problem there is that to get capital, you either have to sell shares. They don't want to do it because the valuations are low.
Yeah.
You need to sell assets. If everybody wants to sell, you're not going to get the best price. The better solution for them is to actually be able to earn their way into having more capital. And that's where LTRO comes in. That's giving them a long enough runway to, you know.
Lots of European banks borrow for what, 1% for
1%.
the next, for 3 years, and it's kind of alleviated a lot of the stresses in Europe.
The liquidity stresses we think have been put to bed in the near term. Again, 3 years from now, they're
Still got to grow.
They still got to grow, and they have to approach it. So they need more liquidity. They need more capital. The other thing they need to do is they need to get their fiscal houses in order. So the first rule of getting out of a hole is to stop digging. They need to stop digging and try to get balanced, and there has to be enforcement behind that. And then the last thing, they got to get their structural imbalances taken care of. You can't just have Germany and the stronger countries exporting to the weaker ones.
Fixed income could come crashing down if the Fed ends QE2, doesn't launch a QE3. Is that in the back of your mind when you're buying fixed income?
No, I don't think it's quite as concise as that. Again, the lower rates get, the more the odds can turn against you, but we think there's a long runway. There's still a lot of deleveraging going on, and we don't see rates going up in the immediate future.
Junkies get mad when you take away their
fix. Yes, that's right, but we think there's still some room.
All right, Matt, thanks a lot for stopping by.
Hey, it was a pleasure. Thank you.
Matt Freund from USAA.